Welcome back. We're still in conversation with Nick Timberlake of HSBC Global Asset Management. We're talking about the emerging market space and its performance vis-a-vis developed markets. Nick, how do you see the concerns coming out of the developed world? I mean, there is growth happening there, but it's not like they're completely out of the woods out of the financial crisis, and the ramifications of that on emerging markets.
Yeah, I mean, I think this year, anyway, there's been a lot of interest by investors in the idea of somehow or other it's time to switch out of emerging markets into the developed world. I think that call may be a bit premature. Certainly, emerging markets have performed very well relative to the developed world, and maybe we have, a period where there is some correction in that relative trade. But I don't think that's the start of a new trend. I think the developed countries have to face up to the fact that they have very significant debt problems, which haven't really been addressed yet, and in addressing that, we'll cap the potential growth of those countries for a number of years to come. Emerging countries went through all of this back in the late 1990s and the early part of this century, and emerging countries had the advantage of being able to grow faster, and they managed to grow out of their debt problems much faster than I think the developed world will. So when we look back, I think in 2 or 3 years' time, I'd be very surprised if we find that the developed world has somehow or other performed better in stock market terms than the emerging world. And
what about frontier markets within the emerging market pack? Because allocation there is pretty much limited at this point. Do you see that scenario also changing? Because these are relatively under-researched markets.
Yes, I mean, I think you can draw parallels between small cap and large cap in any market, between frontier and mainstream emerging markets. These countries, even taken together, really only represent a tiny portion of emerging markets and a much tinier portion of world markets. So they're small, but I think there is now a place for those countries as an add-on to a mainstream emerging markets portfolio, and there are a number of countries that look particularly interesting to us today. I mean, the UAE, a number of Middle Eastern countries look interesting. Also, some of the African countries, such as Nigeria, which exhibit many of the same characteristics, both demographic and natural resources wise, to the mainstream emerging markets. They're just in a much earlier stage of development.
And given the risk profile of these frontier markets, how are you approaching them? Are you scaling? Are you taking active positions there, or is it a very, very bottom-up approach?
It's a bottom-up approach, but there's much more top-down overlay when you're investing in frontier. And I think if you look at the current issues and the crisis that's unfolding in North Africa today, you also have to accept there's a lot more political risk in each one of these countries. So the way we deal with that is more often than not, political risk is not particularly correlated between one country and another country, and having a broad exposure to many countries can help to mitigate that risk. So in our portfolios today that focus on the frontier markets, we have exposure to nearly 30 different countries.
All right, finally, Nick, before we wrap up the interview, in 2011, how do you see the emerging market equities faring as compared to developed market equities? Which are the regions that you see outperforming in the entire pack?
Okay, so we like the markets that are cheapest. So Russia is a favorite. We like the Korean market. We also like the Turkish market for its growth. Those would be our 3 favorite. We think 2011 will be more volatile than 2010, but we're still expecting positive returns from markets overall this year. And
positive returns would mean how much return?
Well, we hope for double-digit returns. I think if you look at the earnings growth forecasts, the consensus view today is about 15–16% earnings growth. That looks quite reasonable to us. Let's just assume there isn't any more re-rating of the asset class. That could be, roughly speaking, the kind of return that the asset class might deliver this year.
All right, I believe that. Thanks very much for joining us today. With that, we come to the end of another episode of Global Mantra. Catch you next week with another special guest.
The thing I want to emphasize is that people look at gold as a safe haven, but they kind of underestimate the price swings that instrument can exhibit.
Okay, so gold is in a void for you right now.
The great difficulty I have is that what is actually the expected return? And some people are saying it can go to 2,000. Simply, we don't have a clue. There's no real framework that one can use to come up with an estimate of the expected return. It's all about guesstimates.